All right, guys. I just wanted to record this quick video about position size and risk management. I think you guys need it because, yeah, I'm sharing calls here mostly and share my trades, but how you take those trades or how you make use of those trades, it depends on this risk management. Basically, if you don't know how to do it, then it's gonna be you're gonna have a bad time. Okay, so what is risk management? I'm not going to go into too much detail. I just want to lay out the foundation, and I mean, the details are not needed right now. What you need is to know how to size it properly. There's a long short tool here on TradingView on this, see, long position, short position. So let's say if I want to take a long, okay, I'll just put this one here for now. Okay, so there is a clear resistance. I'm just laying out, just making up trade. Okay, there's a resistance area. Now the price is pushing towards that area, right? Okay, let's say your entry criteria is this. Okay, at the breakout of this. All right, and let's what you need for the trade, for any trade, for you to be able to take any trade, you need to have three things. One is entry, exit, and invalidation. This is being the most important because this changes your size. And what do I mean by that? Let's go through. When you double click this tool, you have on under the input, there's the account size. Okay, the account size means how much trading, how much size your total account, total trading account has. Okay, let's say you're trading with $10,000. Okay, it doesn't matter if you have 100,000, but it just we need to know how much you trade with derivatives. Okay, this is the account that you use, and you don't want to use the whole 100,000, but you just dedicated the 10,000 for this account. Okay, so your total portfolio for this trading, okay, futures trading, risk, it can be anywhere between zero point 0.5 to 5. Okay, let's say in crypto I like to use 2% usually, but it depends. This is there is no I know people like they like to say, I trade with 0.5% always or 1% always. I just don't believe in that. I don't use that. I change my risk depending on the setups. For example, if I know that a setup has a better probability, then I increase my risk. If I see that the market conditions are favorable, then I increase my risk. If I see that it's not, if I'm counter trading, I'm decreasing my risk. Stuff like that. And my risk is dynamic, basically. I increase, decrease, I play it along the way. So let's say, for the sake of this, let's say your risk is 2% fixed, okay, and then the rest of these are filled by the tool, okay. Entry price here, ticks. You don't care about the ticks because we're trading crypto. We don't need ticks. This is for forex. Price, profit level, which means the exit, okay. That's automatically here. You see, and then stop level is for now is there, but we're gonna play with it now. Okay, so let's say by taking this trade, you have a predefined target of this, for example. Yeah, I know because there's a level here or whatever. Just we're just making it up the trade, and then since what you need is now you know where you want to enter, when you want to exit, but the crucial part you're missing your invalidation. So invalidation comes, and this is a whole new topic. I'm not going to go into too much detail about invalidations, but the idea here is basically where you're wrong. Let's say in this example you're playing the breakout play, which means that you don't want to see something like this, right? So your invalidation should be like if the price comes below this thrust candle, which takes it out of this range, or the SR level, you don't want it to come back. Okay, so let's say this is the invalidation. If you're using any other technique or style, whatever, the invalidation can be different. Basically, what invalidation means is, now you're longing this, right? It's the point that where you should be reconsider longs, and probably and most likely would like to turn shorts, switch to shorts. You see, in this case, you're playing the breakout. If this price comes back down here again, then you should be looking for shorts. So your long idea is invalid, and you should probably be looking for shorts. So that's the invalidation in general. Whatever the system you're playing, your supply demand. If the demand is broken, for example, if this is the demand, if the demand is broken, then you should be looking for shorts, right? So your long idea is invalidated. So that's the basic premise of the invalidation. So let's say this is our invalidation. Now let's see, and this is our target. Okay, this point of control. Let's say, I don't know. For the sake of this, let's use that one. Okay, what changes? You see, let's lay out the facts. Okay, let's lay out the facts so we have them here under control. So your account size is 10K. Okay, and your risk is 2% fixed. So your risk in dollars, your risk in dollars is, what is the 2% of 10K? Is $200, right? $200. This means for every trade you can lose, you're allowed to lose only $200. No more, no less. It can be less depending on the situation, but again, I don't want to go into too much detail. But once you get this, the rest is simple. So you can risk only up to $200 per trade. Okay, or if you're taking two trades at a time, then you should be dividing this risk to 100. So lower if your risk is 2%, then you should be taking 1%, 1%, for each trade. So I mean, it's common sense, right? You don't want to be risking more than $200 basically. So oops, sorry, something happening here, and I hope the okay, this is better, I guess. Now, okay, what changes here? The one thing that is constant is the risk. Okay, see here. Let's go into detail here. So you had a 10K account right here. Now, what this says, when you click on the tool, what it says is, if your stop gets hit, your account total account size will be 9,800. Okay, which means that 10K minus 200, right? And then here, if you hit the target, which is less important, you're going to end up with 11,881. So, which means that this much is profit, right? Simple. This one will make you this much profit. And what this says is your size. This is the most important because it comes from this. The distance between entry and invalidation gives you this. Okay? If the entry was higher, let's say you quote this trade here, you see it was 10K, 11K almost. Okay, 11K of ETH. So not 11. I'm sorry. It says I just 10.9 ETH. Your position size can be 11 almost ETH. Okay, because you need to see the underlying. You need to multiply this number with the entry price. So that's your dollar value of your position size. And if you enter this size, when the stop gets hit, you're gonna lose $200. If you catch this trade higher, like this, then it says here, see, this number doesn't change because it's your risk is 200 fixed. And now you cannot enter the full 10, right? 11 ETH. You can only enter 5.5 because the distance is bigger now. So that's why once you get this, once you have the risk invalidation, once you know where you're wrong, then you can size. You can even enter the trade here with lower size. Same idea. But the problem with that is it can go against you for a bit and then continue. So you can be underwater at some point. But since this was a big breakout, it didn't really, there was no downside basically to this trade. But the idea is this, this is how you can size. Yeah, you're gonna make less money. This is like only 472 as opposed to the $1,800, but your risk is the same. As long as you know where you're wrong, you can take the trade anywhere, and then the rest comes with your trade management. So you can take profit here, take profit there, take profit here, doesn't matter. But what you need is the invalidation, where you need to know where you're wrong, because that defines your risk, that defines this number. And then when once you know this, then you can, depending on your entry, you have the size. So if I'm saying you, for example, I'm using one third clip, that it means that for this example, my risk is $200 right now, right? So but I will start the trade with 200 divided by 3. So I'll take this much risk for this trade. So if my size at that point was, let's say, 6, okay, I start with two size. Let's say my size is normal size. If I take the full trade here, my size is should be 6 ETH. So it means that one third clip, it means that I'm starting with two ETH position size. And then if it comes down here again, I add more to another two. Or if it breaks out, for example, here, I add the rest of the two. So it's 6. Okay. So one third, one fourth means one fourth of this, my normal position size, my usual position size. But sometimes only for this setup. Okay. Because, for example, if this is a breakout setup, I would use 4, for example, instead of 2, because I'm looking to be more aggressive to the upside. So then this should change as that could be 4% and this could be $400. But then again, if I again want to position like this, so 12, one fourth size is 3 ETH I start with, and then I eat at the rest on the way up or on the way down. Okay, so I think this is a good starter. So you can size properly. So if you miss, let's say, if I say that I took the trade here and you caught it here, then just size properly. That's it. The invalidation is there still. Manage, identify your risk, given the stop, where the stop is, and then wherever you catch this trade, you just size properly. It just says here. It just says here. If you catch it right away, then you can play with it. So this is basically, but just because I say that I'm playing with this, because I have the experience to do that, because it's better to start with a fixed risk that wouldn't, hurt you too much. Let's say you need to understand that you can have consecutive losses. I can have consecutive losses. So after like five consecutive losses, your account shouldn't diminish. Okay. So that's why it's very important to identify this number, risk percentage, correctly, to be on the safe side. Because if not, if this is sized improperly, then what happens is after like five, six consecutive losses, then your account is going to be like, like the have a will take a serious hit. We don't want that. You always assume that will go wrong, because normally new traders assume that everything is going to go fine because their indicator says so, because the chart says so, that it should break now. But it doesn't work like that. It just doesn't work like that. You have to prepare for the worst and be happy with the good one. Okay, it's the other way around. The good traders always think about the downside first. What will I lose if I'm wrong? That's the start point. They're not looking at, oh, what will I never look at this. This is like irrelevant for me. I make what I make, but I make it. Because one if you look at it, oh, I'm gonna make 2,700 something dollars, okay? No, you're not gonna. This is, if you make it, you're gonna, like, you're sitting on the poker table, and then you don't count the chips until you stand up, until you leave the table. While you're still sitting on the table, you don't count your chips, because they're not yours. With one game, you can lose them all. Unrealized P&L is not P&L until you realize it here, and now you have the money. Because there is no guarantee that because your indicator says so, it's going to go. Let's say my favorite setup says 60 to 70 hit rate, which means that 40 to 30 lose rate, right? So I always think about this. Yes, I increase the risk because of this, it has a good rate, but I still keep in mind that it can go wrong. I can be wrong, and I have to be flexible, and I have to accept it and walk away. That's the thing. You always need to think about the downside first, because market is market. For this to happen 100 times out of 100, all the participants, because what we're using is basically, oh, okay, you know what? In the past, when I see a fractal like this, it happened to break it like this. Okay, but the thing is that those traders that caused this to happen are not the same traders that are playing this now, right? The conditions are different. Everything can, all different variables can affect this. There's some whale here that doesn't want to that doesn't want the price to go up, and then they just smash the price down. And that whale wasn't there before. So everything you see is unique. Every trade you take is unique. There's no guarantee. There's no certainty. It's basically random distribution. So you need to understand the fact that, okay, even your best setup has 60 to 70% hit rate. It means that there is a 40% or 30% chance that you're gonna lose. So always think about this. Okay, I'm not gonna take it too long, and I'll cut it here. All right, guys. Thanks. Cheers.